Hello, traders and investors. Steve Ganz here, and welcome to the weekend update for April 6th, 2025. Now, this is not, if you're long the market, what I would call a good weekend update. That said, I'm going to walk through each of the different indexes, give my take on where they're at, what's happening to them, what might happen to them going forward as well. So later in this video, I'm going to share a trade concept or trade idea for you to consider as well. So make sure you listen till the end. So if you've been around our markets for any length of time, you will have heard this adage. And the adage is that our markets take the stairs up and then the elevator down. So that's what's happening. That's another way of saying in many cases that fear is stronger than greed. When people get fearful in the markets, many people panic out. I'm not saying that's right or wrong. It's just a fact of life that when fear comes into the market, you end up with some pretty quick and fast moves happening. So these moves are happening, quite frankly, in such a quick and fast manner right now that I don't feel it's probably pertinent to look at our markets on a daily bar chart right now. I think what we're looking at here is a little bit bigger in scope, which in my opinion means that we've got to go to a weekly chart. Okay, so here we are looking at a weekly chart of SPX. We can see that we had COVID. We dropped 34% in 34 days. Then we had a pretty quick and really aggressive recovery. Then we got into the start of 2022. We dropped 27% in this window over a period of 280 days. So it was more of a chop down. It wasn't the elevator down. And then we took off again, rallied significantly out of that. And that focus was largely driven by AI, the additional profitability that companies might experience as a result of AI. So that's, I think, what fueled us out of this and fueled this significant increase, as well as possibly some political aspirations or political thoughts about how the markets might change, how the profitabilities of companies might change, etc. However, since the start of the tariffs here, we have dropped 18% in 41 days. Fairly significant and fast drop. Now, what's different, in my opinion, about this one? If we go back to COVID, our federal government did what you probably heard the term put in a put. The federal government basically backstopped the United States financial system by putting out lots of money to lots of people quickly and easily. This came in the form of just money arriving in our bank accounts, greatly reduced interest rates, and easy loans. So that took care of kind of the COVID drop and got us rocketing out of that. Then that second drop in 2022, again, there was some Fed things that were done there that kind of helped ease the fears of an inflation front. We basically got superheated because of all that money coming into the markets. And then that trickled out of our markets. That left a little bit of a gap or a void, which caused that market drop. And then we started taking off again, largely because of things the Fed was doing. And probably the bigger factor there is, as I mentioned previously, AI and what AI can bring to the table as far as making companies more efficient, more profitable, getting more out of their current resources. So all of that was, again, causing, in my opinion, a good portion of this run. Now, I don't think it's any secret that this is self-inflicted. I'm not saying that's a bad thing, because much if we have a toothache and we go in and we get a root canal is very painful, but it is self-inflicted and it's there to cure the pain in the root. Now, I'm not going to get into whether or not we were in pain, not in pain. That's a political discussion, and try to not go down that road here. All that said, we were given a quote unquote treatment that some people deemed as a viable treatment, and that treatment is now causing the pain. So what do I see from here? From a technical perspective, I don't see much in the way of stopping this downtrend. Maybe a case could be made that around the 5,000 mark here at these prior lows, maybe we get some form of bounce or reversal. In reality, I think we're probably looking more down here in that 4,500 range before we might see some sort of a pause or a potential bounce. And even when we get a bounce, I think that bounce is going to be sold into pretty heavily because you've got a lot of people that have been panicking this whole way down thinking, oh my gosh, why am I carrying those high level of stock and investment right now when the market's doing what it's doing? I sure wished I would have sold up here somewhere. So if in fact we get back up to there somewhere, I think you're going to start to see sellers coming in with the expectation that there might be yet another down move. Now, the challenge here is that if tariffs are in fact what's causing this, which I do believe it's the fear of the tariff war, combined with some things like there have been some Chinese AI things that have happened where the Chinese are able to extract as much or more out of AI than the United States has been able to for a lot less money and a lot less investment, which creates a big question mark around whether or not all these companies in the United States, the chip manufacturers and all those companies, whether or not their profits are going to be able to be as high as they were expected to be, because companies won't maybe need to buy as many chips as they were originally thinking they'd need to buy. Because again, the Chinese have proven, at least based on current news reports, that they're able to get similar AI performance out of a lot less expenditures in training, in chips, in processing power, etc. So that can certainly be part of what's fueling this whole down move here. Now, the question is there any sort of catalyst that might change this? In other words, with COVID, the government stepped in very firmly and said, hey, we don't know what's going to happen here. We're sending everybody money. We're making money easy to get. Business loans keep you afloat. All of that was an emergency basis, and it gave us literally an instant rebound. Now, I don't see any reason that the government would step in and do that here. I just don't see the same things happening. In addition, in comments that the Fed made on Friday, there was some expectation that the Fed might have come in and maybe softened their stance, indicated that they might ease borrowing in the near future, things like that. They didn't. They basically came in and said, hey, it's not our job to look at the market. We're looking at the economy as a whole. And while the economy may in fact slow down, may even go into recession, the signs right now, there is slowing signs, but it's not signs severe enough to warrant Fed action. So the Fed basically is saying, yeah, we're still hands off at this point. The president probably doesn't have any real catalyst or impetus to change his plans if he's unable to run for a third term. It's, why would he change his tune if a bunch of people are screaming that they're losing money in the market? Because he's not going to be up for re-election anyway. Now, his party may put pressure on him. And again, that's a little bit political. I'm not going to get any more political than that, but it is important to understand that at least right now, I'm not seeing anything that our government or that the Fed is looking to do that might cause a quick reversal here. The only possibility might be that if something changes about the tariffs, if this were in fact a negotiating ploy and some negotiations take place, and a bunch of tariffs were removed or lifted, that might ease the situation. But again, I don't see any reason why that would happen at this point. And the noises that are being made are that this is something we need to do for the future of the country. So again, if that is the firm belief, there's also no reason to probably change their current tariff plans. So this is, again, what I'll call self-inflicted. Maybe there's value to it. Maybe there's not. I'm just pointing out that right now, I don't see much of anything that's going to turn this around. Now, this is the 200-day simple moving average. That might be a likely place for this to slow down or stop a little bit. One other thing that I do like to look at, I look at fast graphs. And fast graphs basically provides a look at the average PE, the average price to earnings ratio, and that's this blue line here. So historically, this blue line has represented the PE of the Fortune 500 companies. We have been overvalued here fairly significantly anyway. That's separate from all of the current drop here. We should have been having a pullback or a drop anyway to get us more back in line with what historical PE ratios have been. But in this particular case, we're coming back to that so hard and so fast. And if the expectation is that companies' profits are going to get squeezed as a result of tariffs, this blue line in theory would be quite a bit lower as well. So we may in fact be going down because the overall earnings of companies may also be going down as a result of tariffs. So I'm showing you this chart because, again, as a way of saying that we have been historically overvalued anyway. A correction was due, but a correction is also now going to be fueled further by the tariff situation and the potential tightening of earnings. So let's get back, take a look at particular charts here right now. So that's the SPX. Of course, the SPY is going to be the exact same chart. Volatility, we can see volatility is spiking hugely. So that is a sizable indicator that there is a lot of fear in the market. I want you also to notice that did not back off going into the close on Friday. That volatility stayed at that high going into the close, and also SPX was hitting all new lows going into the close. There was no relief that happened on that. One other thing to look at here while we're looking at SPX and SPY here is I'm not a huge user of indicators, but I want to look specifically at the orange and blue lines here. So that is the MACD lines. In the past, when we've had these big sell-offs and then we started rebounding, we get a crossover of those MACD lines. That starts to indicate that the pressure is maybe easing a little bit. This other histogram chart here, this one is called money flow. Is money flowing into or out of our markets? We can see that money is flowing out of the markets at a massive scale. In other words, people are aggressively selling stock positions. And here, again, we had that crossover in the MACD after one of these dips when we started back up. We're nowhere near crossover here at this stage of the game. So the MACD is continuing to plummet at this point, and there needs to be a little bit of a stall and sideways movement in the blue line, and then maybe the start of a little bit of an up movement. And at some point, when we get those lines closer to where they're crossing, that's going to maybe be an indication that the worst of this is over. But right now, as they're heading down significantly, that's telling me the worst is not over. We also look at the volume. This red bar right here is the volume on Friday. That volume was extremely high as well. So again, none of those are what I would call positive indicators for our current market conditions. Now, let's go ahead. We looked at VIX already. Let's take a look at the Qs. We're going to see very similar patterns here. So nothing has really changed. We have the same drops in our market in the past. This big drop here, COVID happened prior to that, and then the move up, and then, of course, the elevator down. Also coming into the 200-day simple moving average, which may be an area of some support. But again, a little concerned about that right now. This is the volatility for the QQQs. Again, that's way up there also. And it closed near the highs on Friday. IWM, very similar pattern. IWM did back off its lows a little bit on Friday, but not a lot. And then the volatility for the RVX or for the IWM also closed near its highs on Friday. So all of the indexes right now, from my perspective, are looking like they are considerably weak and are probably going to remain weak for a period of time until something changes, until someone blinks maybe, and some tariffs maybe get reduced or somehow modified, until maybe some companies start coming out and saying, hey, this isn't going to impact our earnings as much as we thought. We're okay with some tariffs if it's going to do the right things for America, and we'll still be able to generate decent profits. We need to hear some words like that. And right now, nobody is speaking words like that. So again, I don't see anything in the near future that is going to change what we're seeing right here, right now. So my outlook for the coming few weeks, at least, is still considerably bearish. That doesn't mean, again, that we won't have a bounce. And in these bear markets, when you get a bounce, those bounces can be large bounces. But I think that we're going to find, again, unless something fundamentally changes, that bounce is going to get sold into rather quickly, rather heavily. So usually those bounces, maybe they're a day to 3 days at max. And then after that, as you get into that third day, that's when you start to see people maybe piling in with more selling. So that's what I am seeing for the foreseeable future in our markets at this stage. Thanks everyone for stopping by. Wish I could tell you something better. If you're short, you got to be loving it. Okay, so this request came from a user, and the request was, given market conditions, maybe suggest a potential trade. Now, this is for educational purposes only. So the trade that I'm going to share here is a simple bull-put spread. Now, we are in what I'm calling a bearish market. I do think we still have downside movement. As I said, maybe all the way down to the 450 range. So what I might want to consider doing is to sell a put spread. I wouldn't do it right here, right now. I would wait until we got more sell-off in the market. I would go out some period of time that might allow the market to rebound a little bit, and I would look at potentially selling some sort of a spread in one of the major indexes. Now, the concept here is that I should get a significant amount of premium for this. We can see that in this case, my max loss would be $429. My max profit, if I sold it right here, right now, would only be $71. But as the market sells off and gets closer and closer to my price, the amount of premium I am going to collect will end up growing significantly. So this is not a trade I would look at doing right here, right now, but it is a trade that I would have on my potential radar when I think volatility is high and I think we might be stalling out at some point. So I'm going to try to toss these in at different times when I can. This is one of many options concepts or trade ideas that someone could consider. And I'd urge you to just model it out here using a tool like OptionStrat and see how it plays out going forward in a paper format. Take care, everyone.